Welcome to Talk Tickers. Watching the TWIP on this one today was, it was a wild ride, wasn't it?
Oh, absolutely. I mean, the early hesitation we saw just completely gave way to this massive high-volume surge.
Right, and we're doing a deep dive into Accenture's Q2 fiscal 2026 earnings today. And if you're an experienced investor managing a portfolio, this is exactly the kind of print you really have to decode.
You really do. The market was furiously trying to digest the underlying cash flow and the execution metrics on this one. It's the ultimate puzzle for anyone watching the enterprise tech space right now.
Yeah. Totally. And we always try to keep a constructively bullish tone here, but there's a glaring contradiction we need to figure out today.
Oh, the guidance versus the bookings.
Exactly. We are looking at a company sitting on a record $22.1 billion in new bookings. Their pipeline is visibly bursting at the seams. Yet, they're telling Wall Street to temper expectations and projecting, only a cautious 3% to 5% revenue growth for the full year.
Yeah, that gap between those massive booking numbers and the cautious revenue guidance, well, it tells us everything about how hard it actually is to implement artificial intelligence in the real world.
Right. So let's anchor ourselves in the reality of the numbers first, before we get into the complex AI narratives. So just looking at the headline numbers, they feel, well, solid.
Solid, but maybe relatively unexciting at first glance, right?
Yeah, exactly. Revenue came in at $18.04 billion, which is about a 4% increase year over year in local currency.
Yep. And GAAP diluted earnings per share hit $2.93, which is also up 4%. So standard mature company growth.
Right, standard stuff. But then you hit this new bookings figure, $22.1 billion.
It's massive.
My jaw legitimately dropped. And it wasn't just a few big deals, right? It was 41 different clients signing individual contracts, over $100 million in a single quarter.
Yeah, 41 of them. Just massive enterprise commitments.
So help me reconcile this. How does a services firm process that kind of sheer volume without their costs just spiraling completely out of control?
Well, the secret is really in the operating margins. They actually ticked up 30 basis points to 13.8%.
Oh, wow.
Yeah, they are keeping their cost structure on an incredibly tight leash while accumulating this backlog. But to understand the disconnect between the $22 billion in signed contracts and the cautious, 4% revenue growth, you have to look at the timeline.
Right, because it's not instant.
Exactly. The mechanics of recognizing revenue in IT consulting have fundamentally stretched out. A client doesn't just sign a $100 million check for AI software and then, flip a switch the next day.
Because you can't run advanced generative AI on a fractured legacy data architecture.
Nope, you really can't.
It's like trying to run a high-speed bullet train on rusted wooden tracks from the 1800s.
That is the perfect way to frame it. Look at the specific example they gave on the call involving a major oil and gas client.
Oh, yeah, the ERP migration.
Right. This company spent the last few years just trying to migrate their core enterprise resource planning software, their ERP, over to the cloud, and that was literally just step one.
Just getting the plumbing out of the basement.
Yeah, they had to untangle decades of messy, siloed data just to create a single source of truth. And only now, with that plumbing finally in place, are they initiating step two.
Which is the AI part.
Exactly.
Yeah.
Embedding AI directly into their supply chain and their asset maintenance workflows. These are highly integrated, multi-year transformations. You map it, you build the data foundation, you test it, and then you deploy the AI. So that revenue drips in over years, not weeks.
I love the analogy management used to conceptualize this. If you think about frontier AI models, like these massive large language models we hear about every day, they are essentially a ridiculously high-performance car engine.
Immense raw power.
Right, immense power. But an engine sitting on a factory floor doesn't actually get you anywhere. Accenture is basically building the transmission, the chassis, the wheels, and the steering wheel so the enterprise can actually drive the car without, wrapping it around a telephone pole.
Yeah, the frontier models provide that raw intelligence, but the enterprise needs the architecture to harness it securely. You need data guardrails, access controls, custom interfaces.
Right, the plumbing.
Yeah, the transmission is what actually translates that raw AI horsepower into forward momentum for a specific business process.
But I have to push back on this a bit because I think there's a massive logical trap here.
Okay, let's hear it.
Let's look at the actual efficiency metrics these AI tools are producing. We keep hearing that new AI coding assistants are accelerating software development by, up to 50%.
Heck, they are.
So if Accenture's developers are coding 50% faster, doesn't that inherently cannibalize their own billable hours? I mean, if you do the work in half the time, you bill half the hours. Doesn't making the coding faster literally shrink the total addressable market for systems integration?
It's a very intuitive concern, and honestly, it is the exact reason the broader market was heavily shorting the IT services sector just a few quarters ago.
Yeah, it just makes logical sense.
It does, but the reality on the ground is playing out entirely differently. AI is drastically lowering the cost of execution, which is actually unlocking previously untouched budgets. It's a textbook case of induced demand.
Okay, walk me through the mechanics of that. How does doing things faster equal more money for them?
Well, consider the massive legacy tech stacks that power the global financial system, mainframes.
Oh, right.
For decades, modernizing a bank's mainframe was considered too complex, too risky, and astronomically expensive.
Because it's all, like, what, millions of lines of COBOL code written in the 1980s.
Exactly. And the people who wrote it are retiring, so it was the untouchable legacy system. Banks would just pay for basic life support to keep it running.
But now,
Because AI tools can read, map, and translate that legacy code into modern languages at a fraction of the historical time and cost, modernizing those mainframes is suddenly financially feasible.
I see. So by lowering the barrier to entry for the absolute hardest, most miserable projects, you suddenly unleash a flood of new transformation initiatives that, no corporate board would have ever greenlit 2 years ago.
Spot on.
The pie isn't shrinking. It's actually expanding into the deepest, darkest corners of the enterprise basement.
And we're still only talking about the basement there. Code conversion and data structuring, that is just the first wave. It's purely an efficiency play.
Right, saving money.
Yeah. But the real prize, the massive margin upside they talked about on the call, is what they call growth AI, moving from cost-cutting to actual revenue generation.
Which requires an entirely different pitch to the C-suite, I imagine. You aren't selling IT maintenance anymore. You are basically selling market share.
Exactly. Take the implementation at Radisson Hotel Group.
Oh, yeah, I saw that.
They moved completely past basic efficiency and deployed what the industry calls agentic commerce. Instead of having a human marketing team manually adjust digital ad spends based on, historical trends, they built an AI-optimized media console.
So an autonomous system.
Right. It reads real-time traveler intent, so search queries, weather patterns, flight delays, local event spikes, and it autonomously reallocates marketing budgets second by second to capture the highest converting traffic.
So the AI acts as an autonomous agent, literally managing the money.
Yes. And the result of that specific deployment was a tripling of their share of direct bookings.
Wow, tripling.
Yeah.
Oh.
That is AI driving measurable, massive top-line growth. When you can walk into a client's office and deliver a system that triples their direct revenue, the conversation about how many billable hours it took to build it becomes entirely secondary.
Because the client is paying for the business outcome, not the developer's time.
Exactly.
And building these highly specialized transmissions, whether it's an agentic commerce platform for a global hotel chain or, predictive maintenance for a deep sea oil rig, it requires an entirely new set of tools.
It really does.
You can't just hire 10,000 generic business grads and expect them to build autonomous AI agents. Which I think brings us to the most aggressive, fascinating part of this earnings call. The M&A strategy and how they're allocating capital.
Yeah, management has upsized its acquisition budget to $5 billion for this fiscal year alone.
$5 billion.
Yep. But looking at the target list, they aren't just buying generic headcount to inflate their numbers. They are executing a highly surgical, deeply strategic roll-up of the AI supply chain.
Let's dissect that shopping list because it is incredibly revealing.
Sure.
They recently closed on a company called Faculty, right?
Yeah, Faculty is a UK-based AI-native services firm with a proprietary decision intelligence product.
Right. And they acquired multiple Palantir ecosystem partners to corner the market on defense and public sector data integration.
Yeah.
But the one that absolutely stopped me in my tracks was their 65% stake in DLB Associates.
Oh, that's a fascinating one.
For you listening who might not know, DLB is a physical data center engineering firm. Why is a soft consulting giant buying a physical construction and engineering company?
Because you can write the most elegant, advanced AI code in the world, but if the physical servers overheat or the power grid routing is inefficient, the entire model fails.
Right, the hardware bottleneck.
Exactly. Frontier AI models require massive clusters of GPUs, and those GPUs run incredibly hot and draw staggering amounts of electricity. The bottleneck for AI right now isn't just software architecture, it is thermal dynamics, it is energy procurement.
So by buying DLB Associates, they are literally acquiring the physical mechanics required to keep the digital brain running.
Yes. If a client wants to build a private on-premise AI network, they don't just need code, they need HVAC systems designed for high-density compute.
It's a full stack offering, from the concrete floor of the data center all the way up to the marketing dashboard. But even with that context, I think the acquisition that truly signals a structural pivot for the entire consulting industry is their $1.2 billion purchase of Ziff Davis's connectivity assets, specifically Ookla and Down Detector.
Yeah, that's the big one.
If you've ever tested your internet speed on your phone, you've probably used Ookla. So to go back to our analogies, this is like a classic management consulting firm realizing that instead of just charging an hourly fee to advise the city on how to build a toll road, they should just buy the toll booth, the traffic cameras, and the asphalt.
That's a great way to put it. Let's look at the financial mechanics of that specific Ookla deal because it really represents the holy grail for an IT services firm.
Okay, break it down.
Ookla has roughly 430 employees, but they generate $231 million in highly predictable, high-margin subscription and licensing revenue.
That revenue per employee metric is just staggering. I mean, those are pure software margins, not services margins.
Right. And it represents a deliberate hunt for what the industry calls non-FTE commercial models.
So FPE stands for full-time equivalent, right? Yeah.
Exactly. Historically, the consulting business model was brutally linear. If you wanted to grow your revenue by 10%, you basically had to hire 10% more people to bill out more hours.
Which is highly labor-intensive, incredibly sensitive to wage inflation, and you're constantly battling talent shortages.
Yeah, you are basically a massive temp agency for really smart people.
Right.
And that's exactly the problem they are trying to escape. By utilizing their massive balance sheet to buy high-margin proprietary data platforms like Ookla, they decouple their revenue growth from headcount expansion.
Oh, I see.
When a global enterprise client wants to build a resilient, distributed AI network, they need constant, real-time network intelligence to ensure latency doesn't kill the application.
And Accenture now owns that proprietary global network data.
Yes. They don't just bill for the hours to analyze the client's network anymore. They license the platform that monitors it globally. It fundamentally shifts their financial profile toward recurring software revenue.
Okay, so let's summarize the bull case we built so far. We have a $22.1 billion booking pipeline, heavily weighted toward advanced induced demand AI projects. We have a $5 billion M&A war chest, actively acquiring the physical infrastructure expertise and non-FTE recurring revenue streams.
It sounds like an unstoppable juggernaut.
It really does.
Yeah.
But there is a clear reason the top-end guidance is only 5%. There are hidden landmines in the macro environment. If they own the toll booth and the pipeline is bursting, what is the anchor dragging this whole ship down right now?
Well, the near-term guidance reflects some very real friction that you just cannot ignore. First and foremost, the U.S. federal business is currently creating a full 1% drag on the overall growth rate.
A 1% drag on a $70 billion global revenue base is immense. What is the mechanism behind that slowdown?
Federal procurement cycles are notoriously rigid.
Oh, of course.
You are dealing with continuing resolutions, budget standoffs, and just massive bureaucratic inertia. While commercial enterprises can pivot their budgets to AI in a matter of months, federal agencies operate on multi-year appropriation cycles. The money simply moves slower.
Right. Makes sense. What else?
Secondly, the management explicitly noted that their entire guidance assumes no major economic disruption or escalation from the ongoing Middle East conflict.
Which, given that they operate globally with thousands of employees and delivery centers in that specific region, that is a very sobering, necessary caveat.
Very much so.
Purely from a macroeconomic standpoint, any disruption to global trade routes or energy markets immediately tightens enterprise discretionary budgets.
Which brings us to the core tension of this entire analysis today. The enterprise spending environment remains incredibly cautious.
Right.
Outside of these massive existential AI mandates, everyday discretionary IT spending is still very tight. CFOs are scrutinizing every single dollar.
Okay, so time for you to play the skeptic again.
Go for it.
If the macro environment is this uncertain, if enterprise spending is generally cautious and federal budgets are a known anchor, why did the broader market digest this report and bid the stock up so aggressively on heavy volume?
It's a great question.
Why did institutional buyers step in if the near-term headwinds are so clearly visible?
Because institutional investors look for the ultimate market pacifier during uncertain times, and that is pristine free cash flow,
Ah,
When the macro waters get choppy, smart money gravitates toward fortress balance sheets that are aggressively returning capital to shareholders.
let's break down that cash flow anchor then, because the numbers on the call were wild.
They really were. They raised their full-year free cash flow guidance to a massive range of $10.8 billion to $11.5 billion.
Wow.
But to really understand the quality of those earnings, you have to look at their free cash flow to net income ratio,
Yeah.
which currently sits at 1.3.
So for you listening who might not live in financial modeling spreadsheets all day, what does a 1.3 ratio actually mean in plain English?
It means that for every single dollar of accounting profit they report on their income statement, they are actually generating $1.30 of cold, hard cash in the bank.
Which is huge because accounting profits can be manipulated with, like depreciation schedules and non-cash adjustments.
Exactly. Free cash flow cannot be faked. A 1.3 ratio proves that their profit is incredibly clean and highly liquid.
And they are utilizing that liquidity as a weapon right now.
Yeah.
Between the $4 billion already spent on share repurchases this fiscal year and a newly announced 10% dividend hike, management is heavily subsidizing investor patience.
Yeah, they are effectively paying their shareholders handsomely to sit comfortably and wait for that $22.1 billion in AI bookings to clear the complex plumbing phase and eventually convert to recognized revenue.
Right.
In a market that is deeply nervous about bloated tech valuations and, AI companies that don't actually make money yet, a highly profitable, cash-gushing dividend grower with a massive AI tailwind is a very attractive place to park institutional capital.
Which perfectly sets up my absolute favorite part of the show. We are going to take all these insights and synthesize them into action.
Nice.
But let me state very clearly, this deep dive is an intellectual exercise and is not financial advice. Do not trade your retirement account, your kid's college fund, or your mortgage based on a deep dive.
Absolutely not.
But if I were a hedge fund analyst marching into the investment committee right now, armed with everything we've unpacked today, here is the outrageous but plausible trade I would pitch. I'm calling it the AI execution divergence pair trade.
I always love a good pair trade. Walk us through the mechanics of this one.
Okay, so the play relies on the massive gap between the premium consulting firms and the legacy bottom feeders. First, we go aggressively long on Accenture out-of-the-money call options expiring in calendar Q4.
Okay, why Q4 specifically?
We are specifically timing these options to capture the exact moment that the 1% U.S. federal business headwind definitively rolls off. As federal budgets finally clear their bottlenecks and convert back to growth later in the year, the top-line revenue will unexpectedly re-accelerate, catching the market off guard and repricing the stock upward.
That makes a lot of sense. And the other side of the trade?
Simultaneously, we fund those long positions by shorting a basket of Tier 2 legacy offshore IT services firms. I'm talking about the firms that are still trying to survive by billing hourly for basic code maintenance and software testing.
Ah, the temp agencies.
Exactly. They completely lack the $5 billion M&A war chest required to buy their way into the physical data center engineering space or the proprietary data infrastructure space. They could never afford their own version of the Ookla acquisition.
So what's the core thesis?
The thesis is this. AI is going to mercilessly hollow out the bottom of the IT services market. Basic coding and simple summarization are becoming a race to zero on price. While the Tier 2 firms fight a losing battle for scraps at the bottom, the premium players who own the proprietary data, the ones building the entire transmission and chassis for the Fortune 500, they're going to capture all the margin expansion.
The structural logic holds up beautifully. The divergence between the haves and have-nots in enterprise services is only going to widen as the sheer complexity of AI implementation increases.
Right.
Because if a consultancy cannot offer end-to-end reinvention all the way from the thermal dynamics of the data center up to the autonomous agentic commerce marketing algorithms, they are going to be commoditized completely out of existence. Your trade captures the reality that AI doesn't lift all boats. It sinks the fragile ones and propels the dreadnoughts.
Exactly. So if you are looking at your own portfolio or even your own company's strategy, you really have to ask yourself which side of that divergence you are sitting on right now.
And that actually leads to a fascinating implication, which is the final thought I want to leave you with today.
Let's hear it.
We spent this entire deep dive talking about how Accenture is building this ultimate proprietary AI architecture for the biggest companies in the world. But think about the second order effect of that success.
Okay.
If Every single Fortune 500 company eventually hires the exact same premium vendor and relies on the exact same proprietary global network data and utilizes the exact same agentic commerce algorithms to run their business. What happens when everyone possesses the exact same edge?
Oh, wow.
Does corporate strategy cease to exist? Does market dominance simply devolve into a brutal zero-sum battle over who has the largest budget to buy the most compute power?
That is a wild thought. When the entire global market is driving the exact same high-performance car, I guess the only differentiator left is how much gas you can afford to put in the tank.
Pretty much.
Well, thank you for tuning in to Talk Tickers. Take some time this week to evaluate your own portfolios against the looming wave of agentic AI. Until next time, keep digging into the data.